It's the video many of you have been waiting for and asking me about, so I will unveil my entire new and improved dividend portfolio designed to provide my wife and I consistent passive income. As a matter of principle, I always want to be completely open, honest, and transparent with you guys about my investing journey. So I promise to be a bit more consistent with my updates on my own portfolio in the future. Maybe not monthly updates, but maybe every 3 months at the very least. So my goal is really not to show off with this video, guys, but really to motivate you, to show you how easy it is and help you on your own investing journey so you too can become financially independent and one day join the fire club like myself. That's always been the mission of this channel. So just a quick summary of my investment strategy and philosophy. I am a long-term buy and hold income focused investor. So the primary objective of this strategy is really to generate a consistent passive income via dividends to pay off all my living expenses. So this means that I only invest in stocks that provide a dividend or a distribution with the intent of holding them really long-term or forever. To really live off the passive income they provide. So this strategy has enabled my wife and I to become financially independent in our mid-30s back in late 2019. So if you want to know more about my strategy and philosophy in detail, make sure to check out the video I made where I review that in detail. The link should be flashing on your screen right now. So my strategy might not be fun and exciting or mainstream, but I can promise you that it works. And you just need to stay focused. You need to stay disciplined. Don't forget, slow and steady wins the rat race. Three quick things before I unveil my portfolio. Number one, I will be showing you my portfolio in a spreadsheet and not directly in my broker account. That's because my main income portfolio that I'm about to show you is really a combination of 4 accounts. My TFSA and my cash account, and my wife's TFSA and her cash account. So this is my main income portfolio, and the income it generates is what we use to pay off all our living expenses, and the rest, if there is, gets reinvested to make even more passive income. Number two, this fund does not include our RRSP accounts or our retirement accounts. Those are completely separate, and I will make an updated video on those accounts soon. The reason I keep them separate is really because of how the RRSP accounts work, right? As you know, you can't withdraw any of the money until retirement when you turn them into RIF accounts or RRIF accounts. So I say retirement, but the truth is you could turn them into RIF accounts really whenever you want. But when you do, you can no longer contribute to your RRSP. Don't forget that. So we'll probably wait until our 50s to do that. So the dividends in those accounts, in the RRSP accounts, are really compounding every month, either via a drip or manual reinvesting. So number three, I will be focusing on my portfolio and my holdings here, not on the layout of my portfolio template. I made a separate video covering that in detail. So I explain all the formulas and all the sections of my template. So if you would if you like the way I set it up, or you like my template, don't forget that you could watch that video and download a blank template yourself on our website at passiveincomeinvesting.ca. So without further ado, here's my portfolio. All right, guys, here it is. Before I go through my holdings one by one, which I will do, I just want to review of how 2020 was for me. So in total, I made almost $48,000 in dividends alone, as you could see here. But I do have capital losses of a little over $34,000. It doesn't bother me a bit. This is really because of all the big major cleanup I did this year to really lean out my portfolio, consolidate it, make it a lot safer, make it a lot better. So unfortunately, I did get rid of a lot of the single stocks that I had. Beginning of 2020, I had actually over 120 stocks, which was a bit ridiculous. So right now I have 54, believe it or not, so less than half. But unfortunately, I had to take capital losses with all the cleanup that I did, but I don't really mind it. I mean, 34,000. My portfolio is about 640,000, so it's just about 5%, so it's not a big deal, and I really don't care about it. Let me tell you why. Because capital losses can be carried over forever, and you could always go back through up to 3 years to offset your capital gains. As you can see, 2019 I had 6,000. 2018 I had 10,000, and 2017 I have 2,000. So when tax season comes along in a few months, I will use these losses to really offset those gains. So half the capital losses are really gone with that, and the rest I will simply carry forward. Really no big deal. So if you're asking yourself, well, what happened? I thought you were a buy and hold investor. Well, my answer is yes, I am a buy and hold investor. But like I said, I took the losses and did sell a lot of stocks really to lean out my portfolio. So the holdings I have right now, which I will go through, I do not plan to sell many more. Maybe a couple of single stocks that I still have, but not much more. In terms of 2021, so this is really the data for the first month. As you could see, just in dividends in January alone, I made $5,500, which is great. I do have some capital losses already. That's simply because of two transactions, because of SIR Royalty, which is a restaurant franchise company that it did absolutely horrible this year because of reasons obvious. So they're actually planning to go private. So I decided really to sell it off because the stock price is not going to move because they sold the company, right? Or they're going private. So I took about $5,000 loss on that one, but I made up for it because I also sold Brookfield Property Partners because it seems like they too are going private. So what happens is when a company goes private, it's delisted from the stock market, and whatever the stock ends at, that's the money you get. So I just decided to sell off Brookfield Property Partners, not because I didn't like it, but simply because they're going private. And I did get some gains off that, which offset that $5,000 loss. That's why you see minus 3,200 instead of 5,000. So now let's get into the portfolio. So we'll go through each section one by one. As you could see here, I separated by section. So income funds are here, ETFs, split share funds, single REITs, and single stocks. So starting with the income funds, I really love income funds. They're really designed for one thing, like the name says, income. Keep in mind that I call them income funds simply because usually they end with an income fund, the name of the fund, I mean. But technically, they're really investment trusts. That's why there's the .un after most of them, just like REITs, right? REITs are also investment trusts, real estate investment trusts. So some of them don't. These are, considered investment corporations, I guess, or they're also considered closed-end funds. So a lot of names for them. I just simply call them income funds. So Canoe Financial EIT Income Fund is really the crown jewel, I would say, of my portfolio. My biggest holding at 4.70%. I put $30,000 in here. This is a really good, big closed-end fund on the TSX. It's one of the biggest ones. It's over $1 billion fund. It's really a nice mixed sectors fund. It does have mostly North American stocks, but it's really global. It has some international in there as well. Really, really high yield. This was probably one of my first original OG dividend stocks that I've kept throughout the years and kept adding to it. They've been paying a 10 cent a month distribution for the longest time. My yield is over 12%, so a really nice source of consistent income. The next two are from Brookfield. So these are the two Brookfield income funds that are listed on the TSX. So you have the infrastructure one, BGI.UN, which was a pick for February, a stock pick. And there's also BSO.UN, which I've been getting some questions about. So BSO.UN is a really interesting fund. It's very, very high yield. I nabbed it at 3.58 stock price. It's a little bit higher than that, so the yield is a bit lower now. I think it's at 13%. But either way, this is an interesting fund because it focuses on infrastructure and real estate, which is really the specialty of the Brookfield fund manager. But what's interesting is that it's 75% corporate bonds or corporate debt. How it manages to sustain such a high dividend, I really don't know. It's been around since I think 2013 or 2011. It started at $10 and it's gone down significantly. It's way under $5. I think it's $4 something. So I have a feeling that the dividend might be reduced on this one. But they haven't done it yet. I mean, I keep getting surprised every quarter once they announce their 15-cent dividend, which they have not missed since inception. But I would definitely, very interesting, but I definitely wouldn't put a huge percentage of my money here. I think BGI.UN is a little bit safer because it really focuses on, the yield. It also focuses on infrastructure, but the yield is a little bit more lower at 9 or 10%. DS and Inc.UN are the only two non-split funds by Quadravest. So DS is very interesting. I like to call this one the little brother of Dividend 15 or DFN. It pretty much has the same holdings, except it does not have that unit NAV threshold limit that split corps have. Inc.UN is a very good fund, one of my favorite financial sector funds. It has not only Canadian financials but also US, and it's not just banks. It has life insurance, asset managers, so a lot of stocks in Inc.UN. I really like it. And DS and Inc.UN both have a very unique dividend policy. Like I wrote here in my annual dividend in the comments. So the monthly dividend varies, and it's basically 10% of whatever the share price is of the previous month, the last 3 days. So if the last 3 days the average share price was $10, well, the annual dividend will be $1 for that month. So $1 divided by 12 will get you your monthly dividend. So a little bit confusing sometimes, but really once you read up on it and see how they work, really a good dividend policy, if you ask me. CLM is one of the only, I only have 3 US listed stocks in my main fund. I like to keep my US listed stocks in my RRSP accounts because there is no 15% withholding tax. So CLM is kind of like really the US version of EIT.UN in my opinion. It's an income fund. It's really high yield. It's really, if you look at it, it's going to say 16. I have it here as 13% yield because I removed 15% of it because I wanted to get, because of that withholding tax, right? You have to pay a 15% withholding tax on any dividends you get from a US listed stock. So I have 15K in here. I'm not planning on putting more because I do have a lot of it also in my RRSP. So 15K I think is reasonable, and I'll just leave it at that. So those are my income funds. Really good for high income. And the 2 Quadravest ones are the only ones out of the bunch that use a covered call strategy. That's why there's a little star. If you scroll down at the star, you'll see covered call strategy here. So yeah, and the rest are more classic income funds, I would say. Really the closest thing that you'll get to an actively managed mutual fund that's listed on the stock market, listed publicly. So there you go. Those are my income funds. Let's move on to ETFs now. I love ETFs. ETFs are really my bread and butter. So the first 4 are what I like to call the BMO regional baseline ETF. So these are kind of like what I always suggest to people that are just getting started. These 4 should be the cornerstone of your portfolio. It's very simple. They're basically 35 stocks in ZWC, ZWS, ZWE, 35 of the best dividend stocks for that region. So C is for Canada, S is for US, E is for Europe. Then you also have ZWG, which is really global, although it does focus a lot on US stocks. Well, that's simply because the best dividend stocks in the world are primarily in the US. So ZWG is basically a nice mix of all over the place. I mean, there's Europe, there's US, there's Canada, there's Australia, and there's a bunch of other places. So really the 4 baseline regional ETFs. I have ZPH, very interesting. This is a put right strategy ETF. So a put right is basically very similar or pretty much the same as a covered call strategy, except that the fund does not hold the underlying stocks because you're selling put options, which are options to buy stocks, not options to sell. So a little bit there as well. I really like it. Good for consistent income, very low risk as well. ZWU, that's my favorite one when it comes to utilities and telecom. It focuses only in North America, however, but you really have the best utility and telecom stocks in ZWU. ZWK, this focuses on US banks specifically. I managed to get it really cheap at the beginning of, near the crash, which is why I have a really nice 10% yield on it. I think now it's yielding something like 8.5 or something like that because it went up in price. Really good way to really get the best of the best when it comes to US banks. But keep in mind, it's very specific to US banks. So a little bit higher risk just because it's very specific exposure. Compared to Inc.UN, this one I prefer it a little bit more when it comes to financial because it has about the same yield. It has really high yield, but it also has Canadian banks and US banks banks and also life insurance companies, etc. This one is a little bit really specific to US banks, but I still like it because BMO are some of my really favorite covered call ETFs that I trust the most. The next four are from CI First Asset, another one of my favorite covered call ETF providers. They're really smart with the uniqueness of their funds, and they're really specialized not in region like BMO is, but in sector. So FLI, one of my favorites, very, very unique because it has it's financial, but it only has life insurance companies. So the top 10 life insurance companies in North America, 7 from the US, 3 from Canada, really, really high yield, and it's done absolutely phenomenal over the years, especially 2020. So to be honest with you, the CI First Asset covered call ETFs have really done extremely phenomenal in 2020 because, as you know, the covered call premiums actually go up with volatility. So there was a lot of volatility in 2020. That's why the income for these guys were really high in 2020. Keep in mind though that their dividends are not monthly, they are quarterly, and they do vary. So a little bit annoying to keep track of them or track the income, but still very much worth it. So that's FLI. NXF concentrates on energy, one of the only energy specific funds that I have. What I like about this one, and here again attests to the uniqueness of CI First Asset, they have like the fund says, energy companies, but they don't have any Canadian energy companies. I thought that was really interesting. Keep in mind that if you get something like ZWC, you're gonna get you're gonna get a couple of energy companies focused in Canada. So this is a really nice way to get more global energy exposure. I really like it. A lot of companies in China here, and places like Colombia and France, and really places even Norway, I believe. So really cool exposure here. TXF is my go-to when it comes to pure technology stocks. Obviously, most of the stocks are going to be US, like Apple, Microsoft, Amazon, Visa, AMD. The chip makers are there too. So really, really good way to get a high yield off technology stocks, which is very hard to begin with because a lot of technology stocks either don't have a dividend or have a really small dividend. So this fund has done extremely well in 2020. It's given out a lot of high dividends as well. CGXF is for gold miners and producers. So this also has done pretty good because of the high volatility with gold. Keep in mind that this focuses on the gold miners and producers, not on the commodity itself. The next two are my favorite two from Harvest, another one of my favorite cover call ETF providers. HHL is definitely their flagship ETF. It has 500 million in assets. It's their biggest fund, and it focuses on healthcare. So this is really my go-to when it comes to healthcare exposure. You have amazing companies here. HUTL, it's also utilities and telecom, very similar to ZWU, but the uniqueness of it is that it's global. It doesn't focus just on North America. So if you look at the HUTL in detail, which I suggest you do, it has a lot of global exposure, places where you'll be surprised, and hard to reach places like Spain, Norway, Sweden, etc. A bunch of cool places, which is harder to reach. So really cool fun to get some good access to utilities and healthcare outside of North America. IDR, one of my go-tos for real estate. I know I've talked about this fund many times. I love it. It's probably my favorite REIT ETF. It's one of the only ones that doesn't have a covered call strategy. However, it's managed by Middlefield, really real estate experts. My next two are from Global X. These are my other two funds that are US listed stocks. I keep a lot of QYLD and RYLD in my RRSPs as well, but QYLD I absolutely love. I made a recent video about this. It basically sells covered call options on the NASDAQ 100 index, and we all know what's in the NASDAQ 100 index. It's mostly technology companies, so it complements TXF really nice. RYLD, same concept as QYLD, except it writes covered call options on the Russell 2000 index, which is an index that tracks about 2,000 smaller to mid-cap US companies. So a good way to get exposure to some smaller US stocks that you don't really hear about. Keep in mind that QYLD and RYLD have really high covered call income because they sell at the money call options instead of out of the money. So it means that you're really sacrificing the entire upside, but the trade-off is you get a massive amount of dividend. As you can see here, I'm hitting high nines, and this is even with the 15% withholding tax reduction. So really good. HGY, this is complements CGXF well because it focuses on the gold commodity itself. So this ETF holds physical gold. The ETF is backed by physical gold, but it manages to give a really nice dividend yield of about high 5, low 6% because it actually sells covered calls on it. So very unique. One of the best ways that I found to actually get dividend income with physical gold. HMMJ is where I get my cannabis exposure. So this is one of the only ETFs I really have in my fund that's more for growth and not income. I really think cannabis will explode in the next couple of years. I think it might take a long time. But this ETF has a unique feature that it actually gives a quarterly dividend because of securities lending. I made a few videos on just this ETF, so check it out if you're interested, but probably the only way to actually get some dividends, even though it's not the main purpose and they will vary quarterly, but one of the only ways to actually get income off cannabis stocks, which most of them do not have a dividend anyway. All right, moving on to split share funds, really the cash cows of my account. We all love split share funds, right? The income is just through the roof. So I've did a little cleanup, and I only own 6 right now, and I'm not planning to own more anytime soon. These really 6 are my favorite ones. So you have DFN and FTN from Quadravest. So DFN and FTN are really the flagship products for Quadravest. Like I explained earlier, DFN is like DS's older brother. It has 15 Canadian dividend stocks in there. It's been around for a really long time, and it only recently missed a few 4 dividends in 2020. But besides that, it's been giving the dividend for over a decade. So really solid. And definitely the flagship split fund that I have. FTN focuses on financial only, just financial stocks. A little bit more dangerous, I would say, than DFN. It recently had a share price consolidation, so I basically lost 60% of my shares, unfortunately, and that's why the dividend yield is a little low here at 9.90. But actually, now would probably be a good time to pick it up if you're interested in this one. The next 3 are from Brompton. I really like the Brompton split funds, and I'm starting to like them a little bit more, honestly, for the Quadravest ones, over the Quadravest ones, because they perform really well, and I've recovered a lot quicker, or the unit nav has recovered more over DFN and FTN. So LBS is it holds 10 stocks, the 6 big Canadian banks and the 4 Canadian life insurance companies. So 10 financial stocks a total. The highest yield that I have in my account, I really like it. SBC and GDV are really and even ENS, I would say, these are the 3 safest split funds I have. So SBC focuses on the big 6 Canadian banks, had a really phenomenal performance in 2020 simply because they did not miss any dividends, which was very hard to do in 2020 with a lot of volatility. And now the unit nav is over $20, which makes it a really safe, over $20, which means it's way over the $15 unit nav threshold. So if you're asking me which are the safest 3 split corps right now, it would be these 3 for sure. GDV, I love it. It's very unique split fund because it very diverse. It's called the Global Dividend Growth Split Fund. So it focuses on really worldwide global dividend stocks. It has like over 50 stocks in it, which is very unique. Usually they have, either 15 or 10 or 6 stocks or even 1 stock. But GDV is really special because it has so many stocks, which I find is good because it just adds more safety, stability because of the diversity, right? So this one has not missed a dividend ever yet, but it's relatively new. I think it's just a couple of years old. ENS, of course, this is where I get my Enbridge exposure. So instead of buying Enbridge directly, I get ENS. It's a split fund that only holds one thing, Enbridge, and the unit nav is really good. It's about $20 or even more. It has not missed a dividend ever. And it's one of the only split funds that has increased their dividend. I've never seen that ever except for ENS. So a really solid way to own Enbridge, which is the crown jewel of the Canadian energy sector. All right, moving on to my single REITs and stocks now. So I really love REITs. I own a lot of them. It makes complete sense for me because I don't own any physical property, so it makes sense that I own a lot of REITs here. Now, of course, you don't have to buy single REITs, guys. I know I promote them, but you could just simply buy a REIT ETF. It's the safer way to go. But I really like single REITs as well. I like to mix it up, especially the smaller ones. I don't have many of the big cap REITs simply because big cap REITs are the ones that are usually always included in REIT ETFs like IDR, etc. So most of these are really the smaller cap REITs, which are not included in those funds. So they're really high income, they're good income, but they're also good for growth potential, right? Because they're always trying to grow. But they are not immune to dividend reductions. As you can see, there's some red here. So anything that's light red is a dividend reduction, green is a dividend increase, and solid red is a zero, just a dividend cancellation, which I got here. So let's go through them one by one. I won't go too much into detail. But Pro REIT, BTB REIT, very, very similar in what they do. They're mixed, so there's some industrial, there's some office, there's some retail. They both had actually so similar that they both reduced their dividend in 2020 by 29%, which is not really the biggest deal in the world. I think their payout ratios were already a little bit high. So they did a little reduction. I bought some more. I actually bought a lot of single REITs and more in 2020. So I boosted my dividend yield. As you could see, 7.5, not bad. Melcor REIT is definitely the smallest one out of all of them. It focuses on commercial real estate mix as well. So office, retail, industrial in Western Canada. It's very, very small. And it recently announced a dividend increase, which is great. So it reduced its dividend in March, reduced it by 47%, but then it increased it back a little bit this month, which is good. So I'm at 7.59. This one here, Morguard REIT, it's definitely the one that took the biggest beating out of all the single REITs I had, and it's simply because they own a lot of enclosed malls, which it hasn't been great because of COVID. So I did pick up some more and increase my dividend yield, but this one reduced their dividend by 50% back in April. But the good news is, dividend reductions, everyone thinks they're so horrible, but they're not so bad. They present an opportunity to buy more shares, because usually when a dividend gets reduced, people panic, people get nervous, they sell a lot of shares, the stock price goes down, and that's where people like me and you could come in and pick up some really cheap shares, because we are buy and hold investors, right? So I picked some more, and I'm almost at 7% here. But now would be a really good time to pick this one up, to be honest. Morguard, Nexus, and Firm Capital have to be my two top performers, because they have not reduced their dividend. And Nexus REIT actually recently graduated from the TSX venture to the TSX. So really nice high eights here. Firm Capital, which was my REIT pick for the month of February, keeps increasing their dividend every year, which is simply phenomenal. Now, the two big cap REITs that I do have is RioCan and Smart Centers. They're very similar style. They have a lot of retail, but they're going more and more into apartment buildings, residential, especially Smart Centers. RioCan is really focused heavily on retail. That's why they had a bad time. And of course, like we all know, they reduced their dividend in December, and they reduced it by 33%. So I'm only making 5% here on RioCan. Will I keep it? I'm not sure. I might sell it if I break even on it. I definitely won't sell it at a loss. Smart Centers has held strong, so I'm really happy about that. A solid 7.61% here, and it has a good reputation to increase the dividends as well. The next ones are all a small cap as well. Like I said, RioCan and Smart Centers are really the only big cap REITs that I own. Slate Grocery has to be my favorite one out of all of them, to be honest. I have the most money, $15,000. I really like the concept and the uniqueness of it. They invest in grocery anchored real estate in the US. So not only is it specialized into essential tenants, but it's also in the US. So it's great for us Canadians who want to get some exposure in the US, because most of these REITs, as you can see, are all in Canada. So really nice dividend yield here of 10.19. Definitely my all-star when it comes to small cap REITs. Slate Office I really like as well. So they're both from the same company called Slate Capital. And this one focuses on, well, the next three do focus on pure office real estate, which everyone is running scared of now because they think nobody's going to go back to the office and everyone's going to work from home forever, which is complete nonsense if you ask me. So some great value in the office REITs. I picked some up during the crash. And as you can see, I got some really, really nice yields, and they have all recovered substantially. Not all the way from the COVID lows, but really good performance from the office REITs. A lot better than retail, because a lot of these office REITs, their clients are really government clients, high credit clients, like I discussed in other videos. So these are my office REITs here: Slate Office, True North Commercial, and Innovalis REIT. Innovalis is the unique one because it focuses on office buildings in Europe, in France and Germany, whereas the other ones is really North America and Canada. The worst one, no surprise, is American Hotel Income Properties REIT. They suspended their dividend completely. I've never seen a REIT do this, but I guess they had no choice because their hotels were empty because of COVID. I'm down a little over 50% on this one. I think it's at $3 and something. So I'm going to hold on to it. I have a feeling they will re-enable their dividend eventually. When, I don't know, could take 6 months, could take a year, but I definitely wouldn't sell it, even though unfortunately it's the worst case scenario for me, right? For an income investor, is a stock not generating any income at all. So we'll wait and see, and maybe I'll sell it, maybe I won't, I'm not sure. And finally, the single stocks that I have left over. So I only have 11 of them, believe it or not. So this is where most of the cleanup that I talked about earlier at the beginning of the video happened. I cleaned out a lot of single stocks that were either very disappointing, or they had cut their dividend, or I just decided to swap them out for other things. I have kept a couple of them, but as you could see, 3 of them have currently suspended dividends. So let's go through them one by one. Boston Pizza, this one I do like, even though they reduced their dividend. They even suspended it this year, but they reinstated it. And I picked up some more shares, so I have a pretty decent yield of a little over 7%. Anything over 7, I'm not going to complain. So what I like about this one is it's really technically an income fund, as you could see, a .un, but I didn't put it in the section up here because I still consider it as a single stock or a single business. That's why it's in the single stock section. So Boston Pizza, obviously we know what that is, right? Boston Pizza royalty, sorry. It takes all the royalties from all the franchise restaurants of Boston Pizza, and it gives it to us, the unit holder of this fund. Vermilion Energy, what can I say about this one? Complete and utter disaster. This is why. This is what made me take a solemn vow to never invest in a single energy producer stock or energy production and exploration. So this is an energy company in Canada. Although it's diversified, it has some assets outside of Canada, like in Europe. It did horrible. I mean, I'm down like 75% on it or something like that, something crazy like that. They suspended their dividend. They fired their CEO, or they say he retired, but I think they fired him. So I cannot wait to get rid of this one. This is definitely one I will get rid of, even though the company said that they might reinstate a dividend soon. But yeah, stay the heck away from this one. Key Era, not so bad. This is like a mini Enbridge. So this is a midstream, okay? An energy infrastructure company, not an oil and gas exploration and production company. And it's held strong. I mean, it hasn't touched its dividend, and I haven't sold it, even though I'm not making much on it. 5.89. It's still not bad, but definitely a contender for me to sell it, but only if I break even on it. I don't want to take any losses. AFCC has been an all-star for me. I mean, this is one of the few rare funds or stocks that I bought a while ago, back when I went on a shopping spree after I sold my condo, and it has not cut the dividend. I mean, it's very, very surprising. I'm getting the highest yield of 12.42, and this is a very unique company. It's listed on the TSX Venture, by the way. It's very small. They provide specially finance to car dealerships, or people who want to buy and consolidate car dealerships. There's a lot of inside ownership in this company. I think the CEO owns like 25% of the company, so very, very small. And hey, 12%, doing pretty good for me. I definitely wouldn't buy more because I consider this a high risk stock, but hey, if you got some money laying around and you already have a nice baseline portfolio, a couple of grand in AFCC it wouldn't be a bad idea, right? At 12%. I think now it's even higher because the That's at 1.65. I think it's now at $1.55. So you might even be looking at 13% dividend yield right now. Alaris Equity Partners Income Trust. What a story with this one. This one actually was a regular corporation, and then they turned it into an income trust. That's why now there's an AD.UN. So it's a single business as well, like Boston Pizzas. That's why I didn't put it in the income funds section at the top. So very unique idea. I really like it, even though they reduced their dividend, but they already started re-raising it at $1.24 now. So pretty good. I'm making 7.39. And right now it's giving about the same thing. It's about the same price. So I'm broke even on it. They provide specialty finance to small to medium sized businesses. And what they do is they lend them money, and they actually I wouldn't say buy a piece of their company, but they get preferred shares in return for lending them the money. So they really take, I would say this is a really royalty play. They're getting royalties from the companies they invest in or they help out. Diversified royalty would have to be my favorite one out of the single stocks that I have. Very unique concept. I mean, it's called diversified royalty. What more can you want? It's royalty income from business partnerships. So they have about five, if I'm not mistaken, 5 or 6 partners. And they basically just bought the trademarks for those companies and get the royalty streams of their, or a certain percentage of income in the form of royalty streams. So very, very unique, very, very good. Definitely one of my top picks here. Reduced their dividend by only 15%, and I bought more shares when they did that, so I'm making a really solid 8.93. And I have a feeling that they'll probably re-raise it back to 23 cents once this COVID nonsense is over, which will make me get over 10% yield. So I can't wait for that one. Decisive Dividend, what a story with this one as well. I really, really like the concept. They basically buy out, it's a very small fund, by the way, it's also on the TSX Venture. They buy out small manufacturing companies in Canada, and they run and manage them, and basically you get the royalties or the money from those little businesses that they buy out. They have 5 now, and they suspended their dividend as soon as COVID hit. They say out of an abundance of caution. Now, if you look at their latest quarterly reports, they're all very, very good. So I think the guys managing this company are very, very cautious guys. I had some back and forth with them via email. Very nice guys. They actually answered me. And I'm pretty sure they're going to re-enable their dividend, or they say they would, in the first half of 2021. So I expect a dividend reinstatement here anytime. So I'm definitely going to keep this one. A really good buy right now if you're willing to wait for that dividend reinstatement. Exchange Income Corporation, same concept as Decisive Dividend. They buy out companies, except this one is much, much bigger. It's over $1 billion market cap. And they specialize in buying aviation and manufacturing companies. So you would think they would, they would be in trouble because of the airlines, but no. They're so well diversified. They manage to stay strong, and they have not cut their dividend. This is really a dividend stock. So, I mean, their whole point is to provide shareholders a dividend, just like Decisive Dividend, Diversified Royalty, Equity, Alaris Equity. So, a really good one here. But you definitely won't get 9% yield on it now. Now it's about 6. Chemtrade Logistics Income Fund, a very interesting one. It's also an income fund, so you have the .UN. They sell industrial chemicals. The bad part is that the industrial chemicals they sell is for the paper industry and the oil and gas industry. So 2 declining industries. I wish I would have knew that before investing. They also chopped their dividend in half in March of 2020. It was $1.20 for like over a decade, and then they chopped it to 60 cents. Which I feel is very, very safe now. That's why I picked up some more shares and boosted my dividend yield to 6.77. Right now, I think it's giving a dividend yield of about 9%. So pretty interesting if you're willing to take a little chance on this one. IVQ is my second worst disaster after Vermilion Energy. So the premise behind this stock is that they own real estate, specifically senior healthcare real estate. So there was really only 3 senior healthcare real estate stocks in Canada: Extendicare, EXC, which I owned and I sold, Sienna Senior Living, and this one, Invest. Unfortunately, I chose the one which did the worst and suspended their the dividend. The other 2 did not. So I chose wrong. I'm down about 65% on this one. I don't know what's the deal with it, why they had to suspend the dividend, if they did it also from an abundance of caution. So I have no choice because I'm down on it so much to really hold on to it. So that's Invest. Last but not least, Bridgemark Real Estate Services. The company is actually owned by Brookfield Asset Management. This company used to be called Brookfield Real Estate Services. I don't know why they changed it to Bridgemark. I have no idea, but it's owned by Brookfield. And this, although I classify it as real estate, it's not REITs or physical property. It's really broker services. So their main brand that these guys own is Royal LePage. I know you've seen the posters out there when houses are for sale in Canada. They're very big in Canada. They also own two smaller brands. I think it's Via Capital and Johnson and Johnson or something like that. So this is how a very unique way to get a piece of those high commissions that real estate brokers make. I don't know about you, but I'm jealous whenever I see them. I know they make good money. Real estate agents make really good living because of those commissions. So hey, why get mad? Just join the fun and let's get a piece of it. That's what I say. So that's why I invested in Bridgemark. The stock did really poor, or it tanked during COVID, obviously because of the a lack of home sales in Canada, but actually they recovered very, very quickly. And now the stock price is just about the same pre-COVID. So it held on really, really strong. I'm really impressed. And I think it's going to continue to really be able to provide the same dividend going forward, because housing is very hot in Canada, actually in Vancouver, Toronto, and Montreal. So I see this doing well for a really long time. I don't see them not being able to provide their dividend that they've been providing for a really, really long time. So I was lucky. I got it really cheap at $12.60. I think it's at 14 or something, but it's still giving a solid dividend yield of something like 9% now. So this is definitely one of my favorite single stocks. If you would ask me now which ones I would own or like to keep, it would only be about 7 of them. It would be Boston Pizza, Alaris, Diversified Royalty, Decisive, Exchange, and Bridgemark. How much is that? 1, 2, 3, 4, 5, 6. Okay, we'll add AFCC as well. So these are the only ones that I would keep. Like I keep mentioning in my videos lately, I'm getting away from owning single stocks because they're simply more, they're more at risk to cut or suspend dividends. As you could see here, most of the damage that I took when it comes to dividend suspensions and dividend cancellations or reductions, is my single REITs and single stocks. So single REITs performed a little bit better, but there's still, there's still a risk. And this is pretty much why I don't get many single REITs anymore and stocks, just simply because of the risk there. All right, so grand totals, guys. Capital gains, all the capital gains I've made throughout the year since 2012, 84.76. It used to be a lot higher. And it's lower now because of the big capital loss I took in 2020. And if you're asking yourself, well, how did I make these capital gains back in 2013, 14, 15? Well, keep in mind that I only became a passive income investor really starting in mid 2018, mid 2019, really. So that's why there's a lot of capital gains here. This is basically from trading stocks, which I don't do anymore. Complete waste of time if you ask me. Too much time and effort. Total dividends, $73,000. So add these two together and you get the lifetime profit, I like to call, of a little over 80 grand. My total investment, so this is how much money I put in, is just under 640,000. My average dividend yield is 9.77%. I still am shocked when I see this. It's very, very high. I can't believe it, but hey, that's what you get when you're an income investor. You get high dividend yield, right? And this also includes, by the way, the stocks that have suspended their dividend. So if you actually remove those 4 stocks, it's actually over 10%, which is just crazy. So average monthly income of passive income that I'm making, a little over $5,200 a month. Money made back with dividends, really a nice key stat I like to follow is really the total dividends divided by your total investment. So this basically means that I've made back 11.43% of my money so far in dividends alone. So here's the breakdown, guys. I broke down the 4 sections: income funds, ETFs, split, single REITs, and single stocks. So this is the percentage of my portfolio in terms of monetary value, and this is the income percentage that they're providing me. So income funds, 15%. I like 15% for income funds. I think it's good, good number. I definitely wouldn't let it go over 20% of my total portfolio. It's making almost 20% of my income. It makes sense because income funds give really high yields. ETFs is really the bread and butter of my portfolio. This is what I'm going to be focusing on this year for sure to boost this number up to about 30. I would feel comfortable. This is between 30 and 35%. They're mostly covered call ETFs, right? That really perform well during volatility. So covered call ETF is really what makes me sleep well at night. Nice chunk of my income here, 22%. The ETFs provide me. Split funds, I feel personally comfortable of having 15 to a maximum of 20% of my money in split funds. I wouldn't put more than 20% of my holdings, even though it's very tempting. I know I've gotten some questions saying, hey, why don't you just put everything in split funds? Well, listen, it's very, very tempting and you can make a lot of money. But what happens during a stock market crash if a lot of split funds start missing dividends? Well, you're in big trouble, right? So I always like to have a balanced approach to everything, guys. So even though they make up 19% of my portfolio, they give 26% of my income comes from split funds. So very, very powerful funds here for income. And then you have single REITs and stocks. So 23% single REITs and 15% single stocks. So by increasing, my plan is really to keep focus more on ETFs going forward, which will reduce these two percentages, which is what I want. I mean, don't get me wrong, I still love single REITs much better than single stocks, but I mean, this is where most of the risk is if you're an income investor, because these are the stocks, the single ones that are more at risk to reduce or suspend their dividends. That's why I'm going more into ETFs going forward. In terms of sector breakdown, this I made just as an FYI for myself. So most of the funds are really mixed sectors, a lot of financials, which makes sense because they're really the cash cows when it comes to dividends. I do want to reduce this a little bit to make it, not so big. Under 20, I would feel better here, and a little bit more mixed, let's say. Real estate, since I have a lot of REITs, makes sense for me. I don't own property, like I said, so I'm comfortable having even a quarter of my portfolio in real estate would make sense for me personally. And then the rest is just, sector specific things like utilities, telecom, and energy, industrial, healthcare, etc., etc. So there you have it. There you have it, guys. That's my entire income portfolio in black and white. So as you could see, especially if you're a longtime follower of this channel, I own what I preach, right? I wouldn't feel comfortable suggesting a stock or a fund without owning it myself. Keep in mind, guys, also that this is a pure income focused portfolio, really designed for high income and not growth or capital appreciation. It's a strategy and style that fits my personality, and we love it. I mean, this is what made us financially independent in the first place. At a relatively young age, and the proof is in the pudding, right? So please visit our website, guys, passiveincomeinvesting.ca, to access my digital product that I'm very proud of, the Ultimate Dividend Passive Income Investing Package, which includes a huge list of ETFs, split funds, REITs, etc., all really designed to help you build your own income portfolio. It's only $20 right now, but it might go up soon, to make sure you pick it up. And also keep in mind that if you purchase the product, you only have to purchase it one time. If ever I come out with an updated version, let's say a year from now or 6 months from now, you will get the updated version for free. You won't have to buy it again. That's the reason why we ask you to sign up, so we could get your email address. So if there's a new version, we'll automatically send it to you for free. So there are also a bunch of other free tools on our website, guys, to really help you out on your investing journey, like a budget tracker, a blank copy of my portfolio template, which I just showed you. So you could use it as a template to really track your own investments. And of course, an updated copy of my new and improved portfolio, which I just unveiled to you. You could also book a one-on-one video consultation with me personally. If ever you have questions to ask me, you want help building a portfolio, want me to review your existing portfolio, whatever your needs are, I'll do my utmost to help you out and answer all your questions. I've done dozens of them already, and they seem to be really helpful for you guys. And honestly, I love doing it. It's really fun to meet new people and really help them and make them feel more comfortable investing and explaining my strategy. So it's been great so far. And another thing, if you do book that one-on-one with me, I will give you the ultimate dividend package for free. I think it's only fair. So as always, guys, please support me and this channel by hitting that like button. It's free for you and it helps the channel out, so it's a win-win. And finally, make sure you're subscribed so you don't miss out on my future content and community posts, which I started using on passive income investing, which is, it's really all designed to help you guys on your own journey. We're also on Instagram, so make sure to follow us there if you use it. My mission remains the same, guys. It's to help everyday working Canadians to invest on their own in order to build their own stream of passive income, which will enhance your quality of life. So with that, take care, guys, stay safe, and see you next time.